So as we saw from the CPI report, services continue to move up in prices. We also hear from other articles, which I'll link below, where millennials or Gen Z or these young adults that are going out and purchasing a lot of luxury goods and the prices of those moving up. If you've been looking around also for, vacation, heading into Christmas time, vacation, airlines, flights, etc., you might see that, the airlines might be packed in your area. You might see that the tickets are expensive. You might see that even getting a room in a hotel or staying at a place, resort, pretty expensive. So a lot of the luxury items are moving up and up and up. So why is that? Right? Why do we see these items moving up? I thought we are in a recession. I thought, the end of the world is coming. I thought that, all of this job layoffs is supposed to be bad. But what's going on? Now, this article basically talks about these young adults that are either living with their parents, have saved up X amount of dollars, and because of COVID and whatnot, you're seeing this boom and influence of money chasing those luxury goods, luxury items, chasing those luxury vacations, right? May not be all young adults, but also from a lot of business owners as well, where a lot of them took advantage of tax incentives or free money from the government, where if they have extra money, they're going with their family members and purchasing the extra luxury first class seats in the airlines, or getting that luxury vacation or that high class, high end resort for a couple of days, and they're willing to spend the money because they received either a big tax write-off and what have you, right? So you're getting some from the business side, the business owners taking their family out, and then the other where you have young adults, and you can expect during Christmas time and also during New Year's a lot of spending, and probably young adults to continue because some of them are living at home with their parents, saved some money, and ready to experience a good time, right? The question is, how long is this going to last, right? How long until the punch bowl is gone? How long until really higher prices start to creep in and people start to wake up, especially next year when things are getting worse off and when things are continuing to be, especially when you look at essentials like we saw in the CPI report yesterday with the shelter, with the food prices continuing to be higher. You go to the groceries, food at home, food outside continues to be higher and higher. At what point will this stop? And the thinking that I have is that possibly by 2023, next year, we should see a slowdown in spending. Now, the slowdown in spending and consumer spending will definitely affect GDP, will definitely affect growth, which is quite interesting because this year we did see back-to-back GDP for 2 quarters end up in negative territory, which suggests recession, but then the recent GDP that we got came in positive. So are we really in a recession, right? Can we say we're in a recession? And part of that positive GDP comes from consumer spending. Consumer spending is a big portion of GDP. And last GDP number came in higher, and you saw that, okay, the consumer, and consumers are still going out and they're still spending. The only thing is that may be different for 2023 as tightening continues, as people start to figure out, and also the layoffs. Let's not forget about the layoffs. When layoffs start to creep in all sectors, not just for tech, and for tech, this was just the beginning. When we start to see tech lay off more of their employees, when we start to see all sectors also start to lay off their employees, and more tight, the effects of tightening that we've done this year show up next year, definitely you'll see that consumer spending drop. Definitely you'll see that GDP also all of a sudden drop, and it start to create very worse off growth conditions for next year. But right now we're not seeing that. Right now you may look at the data, you may look at news articles like this that I posted in the description, and you may think that, hey, everything's okay, everything's fine. Guess what? Also, another signal that you may think that may be misleading is also the Dow Jones. The Dow Jones is about 3 to 6% away from all-time highs. And you're like, whoa, what happened? For the year, we were down. Dow Jones was down. Now, of course, other indices, if you look at tech, you look at NASDAQ. This is, and I'm recording this pre-FOMC. We'll see where NASDAQ ends up being at the end of the day and at the end of the month as well. But NASDAQ is still down 30%, yet Dow Jones has seen a massive rally and is only 3 to 6% away from all-time highs. It'll be very interesting to see where Dow Jones ends at the end of the year. Again, you could get, if Dow Jones ends up reaching to higher levels, and you do see maybe all-time highs, you could definitely see in the media Dow Jones makes new highs, and people will probably start to think that, things are okay. Now, that will be interesting in terms of the sentiment, the consumer sentiment. If you start to see that, okay, spending, yes, prices are still higher, but, Dow Jones is high, so that means everything is fine. It'll be interesting to see if that sentiment, positivity of the news plays into the early of 2023, which may cause people to maybe chase the equity markets thinking this is the bottom, and then to be hit by reality later on that growth is not as good as what people were thinking. And that's why I did a previous video on that the equity traders, the equity markets are up for a rude awakening, because right now we're not seeing the effects of all this tightening that we've done. Everything looks good. People are going on vacation. Consumer spending, is looking positive. GDP last number was positive as well. So what's the deal, right? Okay, we had some layoffs. Okay, the markets was down in tech 30%. We're fine, right? We can now move ahead and move up higher for 2023. But don't get confused, don't get misled. I could be definitely wrong. This is not financial advice, right? But if I look at past history, 2008 and 2001, it kind of rhymes. Where in 2008 and 2001, we had, before 2008 actually, let me start with 2008. Before 2008, we had a run up in 2006, 2007 while the yield curve inverted, while there was warning signs. And then later in 2008, late in 2008, the market was hit with a rude awakening. And we did get rate cuts from the Federal Reserve, but the equity market still sold off. Same thing in 2001, you still got rate cuts while the data started to show and the growth in the economy started to show a lot of weakness. We got rate cuts, but the equity market still sold off. So next year, it'll be interesting that if we, by the end of this year and early of next year, if we end up moving up higher and anticipating thinking everything is fine, it'll be interesting to see if we follow the same path that we saw in 2008 and 2001, where people think that everything's fine. People think that we're not gonna get a severe recession, or we're not gonna get a recession, a hard recession, or a typical recession. Right now, what's being priced in is a mild recession, and then that throwing off a lot of people, a lot of traders, which would result in panic selling, especially for those who look and read the media, read the articles like this, and think that, okay, it's time to buy, good time to buy, and boom, buy, and then figure out that, hey, it wasn't as good as expected, and you see a big sell-off in the markets. Now, again, This is a possibility. The other possibility is, yes, you do get a soft landing, you do get a mild recession, and it does turn around. That is definitely a possibility, and the markets are pricing in that. But let's not forget that if the markets are pricing in here of the soft landing, then the hard landing is not priced in. And if that starts to become a reality, and we start to figure out that all the spending we're doing this year, all the luxury items and everything looks good, and people are consumers are spending and everything is fine. And then to find out next year that, hey, we're actually going to get a hard landing. Everything that we've done last year, of all the spending and everything, is cut. It's done. And it's going to be worse off, which could bring a lot of repricing and panic in the equity markets. And then we'll wait and see what the Federal Reserve does once that happens, right? They say it takes an average 2 to 3 years for inflation to come down. And if we start counting from this year to the 2022, 2023, probably by 2024, we can maybe reach to the 2% target. Let's see. Leave a comment below. Let me know what you guys think. Subscribe, hit the like button as well, and I'll see you guys around. Cheers. Bye.